Good morning, everyone, and thank you for joining us. My name's Chris Gillings, and I'm a founder at Cutthroat Venture and an investor at 5V Capital. 5V Capital is a multi-strategy funds management firm. We have a private equity fund, a growth fund, and a venture capital fund. I'm one of the leaders in the venture capital fund. We invest at Series A and B in B2B software. And so if you're a founder building in that space, please reach out. You can get us at vc@5vcapital.com. We have a huge day today. We've got 3 sets of guests calling in, and so we're going to get straight to it and welcome our first guest, Jackie from Airtree and James from SquarePeg. Welcome, Jackie and James. So we're going to kick off with some intros. Jackie, do you want to kick off?
Yeah, sure. I'm Jackie Billings, partner at Airtree Ventures. We're everyone who doesn't know, early and growth stage fund based in Sydney.
Awesome, James.
And hello, everybody. I'm James. I'm a partner at SquarePeg. We are a VC here in Australia, but also have offices in Singapore and Tel Aviv, and invest early and multi-stage.
Awesome. Well, thank you both for joining us. So our most recent report we put out, investor sentiment was very strong, but I guess deal volume and funding levels have sort of been flat the last few quarters. Given you guys are two of the biggest funds in the country, you see a lot, if not most opportunities that come across all of our desks. We'd love to get your read on what is actually happening from a market perspective and the level of activity that's going on.
Yeah, I don't mind kicking off here. I think the deal data lags would be my expectation. So
Yeah.
It's probably as busy as it's been in at least 3 or 4 years. At Airtree, I think we're kind of pretty overwhelmed at the moment with investments, so that's good fun. My general sense is, I think, around 2 years ago, a lot of companies got started building with AI and building with LLMs, and so I think a lot of those companies that got started then are now starting to see meaningful traction. And so I would say where a lot of our deal flow 12, 18 months ago was like pre-seed getting started, we're now seeing a lot more. We have 500K to 1.52 million in ARR, and we're raising the next round to kind of go very fast. So that's I'd say that's the majority of what we're seeing right now.
Yeah, I tend to agree. Perhaps the one thing I'd add is that I think we did notice it felt slower than normal in Q1, not in Q2.
Yeah.
I think that in Australia, there's always a rush to get things done before the end of the calendar year, and then that can lead to a bit of a slump at the beginning of the year. For us, that there was a little bit of a dip during that time, but as Jackie said, like perhaps there's a bit of a lag there in terms of that flowing through. But yeah, it's definitely Q2 for us felt very kind of lots going on.
Yeah, I would agree with all of that. So Jackie, you just touched on AI. We're always going to talk about it. You guys are two funds that are both very large, but also have a view that you want to invest in companies that can be globally relevant and be leaders globally. And so I'd love to get your perspective on how the rise of AI and this new technology wave that's come through has perhaps made you rethink on where Australian companies actually have the opportunity to be global leaders. And if you have any frameworks for thinking about that, we'd love to hear those as well. Why don't, James, you go first on that one?
Oh, sure. Well, listen, I mean, I think that Australian companies definitely have the capability to be global leaders in AI. The boring comment is that it's generally going to be in the application layer. We don't have as much going on, deeper in the stack. What that means is that because AI has rapidly made a lot of new opportunities much more proximate internationally, that a lot of these opportunities have a lot of different teams going after them from all across the world. And what that means is that Australian founders really do need to hit a world-class bar, because they're looking at opportunities that often lots of other people are, and also the speed with which teams are able to execute on these new opportunities is really, really quick. So I think as we think about it, some of the things that we're kind of taking into account as we evaluate things like, how amazing are these founders, which is kind of like a return to fundamentals in a way, but also, does this business get better as it gets bigger? Because the barriers to entry in the people following you are falling day by day, and so you need some kind of, commensurate advantage to getting bigger. And so that's like some of the things that we're thinking about as we look at Australian opportunities in AI.
Yeah, the only thing I'd add is I think a lot of the real success stories that you're seeing in the press are either kind of product-led growth companies or influencer founder companies. I'm thinking like kind of Brett Taylor from Sierra type people. And I think kind of what James said is true, which is boring enterprise software has always been a great business model. And I kind of think that will continue. And I think being able to master sales cycles into big companies and do that consistently and have strong net revenue retention and expand within those organizations and all those kind of fundamental building blocks of building a good software company will still hold in this new world. And so while it may not be as sexy as some of the stuff you read in the press, I think that those are the companies that we're excited about.
So you touched on a few of the more traditional ways of examining an opportunity that still run true. Are there any filters or things that you're looking for with companies that are building in that sort of claiming AI to be at the core of their solution that maybe weren't relevant before?
Yeah, for sure. I mean, one of them is, or perhaps the two sides of the coin for me, one, a real deep understanding of the market that they're attacking. So for example, like one of the companies I was just on the phone with this morning is called, one of our companies called GoodWork. They are deep retail analytics folks. They really, really understand retail. And I think that retail analytics is one of those areas that so many big data companies have come in over the years and tried to do something. And really, retailers have been consistently underwhelmed by how those products have they really understood their business. And these guys have come in with deep retail expertise and are really building something. And yes, and it's very much empowered by this next generation of AI, but they really deeply understand retail, and that is helping them develop a product that hopefully can solve that will bridge that divide between technology people and then the subject matter experts, in this case, the retailers. And then on the other hand, I think you really do need that very high level of AI knowledge. And one of the things that we looked at when we were kind of examining the AI success stories, even in the application layer, is that one of the two co-founders is often a real AI expert, like someone who has either worked at a frontier lab or has some kind of rare level of knowledge and insight into how the mechanics of these models work. And you wouldn't actually think that you need that at the application layer. Like it's not necessary, but we were wondering about that correlation. And we think that the tribal knowledge of understanding what these new models can do and where they're going allows you to kind of skate to where the puck is going in a way that's incredibly important when the pace of development is so fast.
Yeah, the only thing James is saying is just kind of taking that point further on, just speed and intensity have never been more important than they are now. I think being able to ship very fast, learn very quickly, kind of completely change your product in a couple of days if like some new capability came out of the layer, that's extremely important.
Yeah. And so how does that all apply to your current portfolio, your portfolio that have been around for several years. You've both got large portfolios that probably weren't building from scratch with AI at the forefront of their thinking. What are you seeing across the portfolio? Are they universally leaning in, or is it sort of across the portfolio vary quite a lot?
Do you want to go first, Jack?
Yeah, I'd say it varies within the portfolio. There are some, like I almost think the larger the portfolio, like the larger the company, the harder it is to make these changes quickly. Although everyone has it as a priority now, I think there have been some exceptional re-acceleration stories in our portfolio where the company has just fundamentally re-architected the product and as a result has accelerated growth. I mean, examples for us would be companies like Rejig and Joyous, where, you know, they have just like fundamentally lent into what the technology enables, changed how they work internally, changed the product externally, and have been able to kind of have a material change in traction as a result. So I think that's the opportunity.
Yeah, I tend to agree. And I think that when you have kind of massive distribution, if you are able to seize the moment, then the opportunities are huge. I mean, I think Canva is doing an incredible job of that. I also think that it gets back to what I was saying before in terms of the fundamentals being really, really important. And when you look at a company like Airwallex, it's a company that absolutely gets better as it gets bigger, and that gives it the ability to kind of take advantage of where it can, these new innovations that are becoming available, while kind of continuing to exploit its growing moat. So I think there are good good news stories in the portfolio, as well as, of course, challenges to kind of taking on these new tools.
Yeah, absolutely. So final question. There is a little bit of a narrative in the press and the rumour mill around that some funds are struggling to raise again, and that there are potentially fewer funds running around deploying actively today than there were a year ago or 18 months ago. Airtree and Squarepeg, documented that they were very successful in raising large funds pretty recently. What's your view on if Australia is to be successful as an ecosystem and continue to grow, where are the opportunities, do you think, for new funds to come to market, or for funds that are maybe smaller or less credentialed than Airtree and Squarepeg to potentially repivot and come to market with a different offering for LPs?
Obviously, it has been documented. I'm not super close to other firms fundraising, so I don't have a huge amount to comment. I do think there are some great companies. There are some great funds getting started that are slightly kind of under the radar. I think Co-Ventures, Maxi Mentis Fund is doing very well. I think NextGen's come through as a student-led fund. I think there are exciting new funds coming through that are taking kind of opinionated approaches on how to differentiate in venture, and so I think there's still an opportunity there if you kind of have a view on how you have differentiated deal flow.
Yeah, I tend to agree. I think that whenever there is a big, fundamental change in our business, and you've got to count this new wave of AI as being one of those, that there is actually an opportunity for new fund managers. And I think what the challenge for Australia is, and for any potential fund manager in Australia, is what is your differentiated level of access to that change, and why are you closer to it, or why do you understand it better than anybody else? And I think from Squarepeg's point of view, we think about that all the time. I'm sure Airtree would say the same, and we're thinking a lot about how are we learning faster than anyone else in this? How are we leveraging all of the AI investing we've been doing over the past decade to really understand it well? But new fund managers have the opportunity to, if they're in the middle of this change, to really take advantage of that. And I think that would be interesting to see. And I think that the examples that Jack's raised are good ones.
Awesome. Well, thank you guys. Thanks, Jax. Thanks, James. Really appreciate the time. This was great. And thank you for joining, and see you soon.
Thanks,
mate.
Before we welcome our second set of guests, I want to tell you about Vanta, our sponsor for today. It's a trust management platform that automates security and compliance so you can manage risk and build trust without the manual lift. Whether you're going after your first framework or scaling a complex program, Vanta replaces point-in-time checks with continuous automated monitoring. Thank you, Vanta, for your support. All right, next up, we've got Taryn and Quentin joining. Welcome, Taryn and Quentin.
Thanks for having us, Chris.
All right, quickly before we get started, quick introductions. I know you guys well, but just for the audience sake, Taryn, can you give a bit of a download on yourself and where you work?
So, Taryn Petersey, I'm a partner at Rampersand. We're an early stage tech VC fund investing in founders with abnormal potential.
And Quentin?
Yeah, Quentin Wallace. I'm one of the partners at Archangel Ventures. We're a pre-seed seed fund investing in mostly Australian companies.
Awesome. All right, let's get straight to it. The report talked a lot about AI. AI is the buzz in our world, and I think even in the real world now. Can you both invest at the early stage in software? Can you talk a little bit about deal flow that you're seeing? Is everything AI, or are there still some companies that are building more traditional software businesses coming through the pipeline? Taryn, you want to kick it off?
Yeah, I'll kick it off. I think everything has an AI angle to it now, and it kind of has to, right? Like, we're talking about investing in businesses for the next 7 to 10 years. If you're not playing with and utilizing AI in your business, you will very quickly be left behind. So definitely seeing everyone with an AI angle. And even from like a founder's perspective, it makes sense. From the late stage, Carter released a report last week showing that 50% of late stage capital is already going into AI businesses. So, if you're building early stage now and you want investment in early stage, we're all thinking about where that next round of capital is. And we're seeing that going into AI businesses.
Quentin, seeing the same thing?
Yeah, very much the same thing, and I agree with Taryn in relation to AI being pretty much most businesses. The way I see it is it's a technology layer, and so if you're already a SaaS business, for example, you're just adding this technology to your stack. It's not a separate business or a separate type of technology. It's part of the stack, and so everyone who's trying to attack a problem is probably now going to add AI to it because it'll just make it more efficient. That said, there are still a few cases where maybe the market's not ready for the AI implementation in the software, and they're still getting from maybe paper to software. So they've got to make that SaaS jump first before they can actually add AI and make it useful to the workflows, for example.
And is that part of your diligence process? So obviously, if there are all companies coming through with a sprinkling of AI in their deck, how do you test that? And do you have a process for really understanding whether or not the company's just AI washing and adding in what they know investors want to see versus actually understanding the technology and implementing it in a way that actually makes the product better and serves the customer better?
Yeah, for me, it's very much about doing your due diligence on the market and the ICP that they're going after, and you need to understand whether they are sophisticated enough to deal with a product that is going to leverage AI appropriately. If they're not, then maybe adding AI at this point in time is probably not the right thing to do. So it's part of the DD process, and for me, it is anyway.
Yeah. So, like, back to your point, Quentin, some industries aren't ready for it yet. So actually, some of the interesting startups that we're meeting are startups who have the end goal of being an AI first business, but they're taking, their ICP on that journey of educating them on, how to use AI into their businesses as well. So maybe not starting with an amazing AI solution, but building their business and their customers towards utilizing that technology.
And what would you say to founders that are going out to raise maybe that very early capital, the pre-seed or maybe a small seed round that currently don't have an AI strategy or aren't adopting it? Like, is it a lost cause, or are there any sort of mental models that they should apply to their own business or the use case to understand whether or not there is a need, like a real genuine pain point or improvement to the product that could be solved by integrating the tech?
I think if they're solving a genuine problem, a genuine pain point, then there's sufficient value there to at least start on that journey with customers. If that initial product doesn't really solve it in an effective way, in the 10x way that people talk about, so on, then maybe they should be rethinking about what the product is. So yeah, there's definitely, as long as you're delivering value, there's potential.
And so you talk about, you both reference sort of integrating AI. And so on that basis, I think I'll make an assumption that you're not looking at a lot of companies that are building at the foundational model level. You're generally looking at companies that are integrating in an OpenAI, an Anthropic, a sort of Llama, DeepSeek into their product. Can you talk a little bit about, in terms of where you think Australian founders have a right to win in AI, both in terms of the stack, so starting at the application layer at the top, foundation layer sort of towards the bottom, and maybe below that are the chips and the data centers, and then everything in between. But then also verticals. Do you think that we have the right to play in verticalized AI, which is where Australia has typically done really well in vertical SaaS? Or is it horizontal solutions, serving maybe a customer service tool that serves multiple industries? Do you have any views on where in that matrix Australia has a really strong right to play?
I'm happy to
Kick
go,
off.
Taryn. You go if you want to.
As you said, Chris, like Australians have historically done very well out of vertical SaaS. And so I think that trend is continuing to play on into vertical AI. I think where we see that being interesting and where Australians can win is where we have deep domain expertise in that sector and then are building that vertical AI solution there. I think from just like a capital point of view, we are playing a lot more in that application space. Foundation level models need a lot of capital, and there are some being built out of Australia, absolutely. And there is sufficient funding here, at least early stages, to do that. But I think in terms of where the volume of AI startups will be funded in Australia will be that application layer, particularly vertical. Horizontal is really interesting. We see heaps of really interesting horizontal players, but it's also, incredibly tough to get to market it and communicate that to their customer set. And so we go hesitantly into horizontal, but we definitely see some interesting opportunities.
Yeah, I pretty much 100% agree with everything Taryn said. Australians' advantage traditionally has been in their ability to execute in the SaaS verticals with low capital raised, and I think that'll continue because while in some ways AI is increasing the amount of capital that founders want to raise, being capital efficient is still going to be an advantage over everyone else in most cases. So yeah, I think that's where being frugal is where internationally we're looked upon pretty favourably, and I think that's where we need to stay.
Yeah, absolutely agree with that. On the topic of being frugal, though, 86% of investors in our most recent survey said that AI companies are attracting much higher valuations than their non-AI counterparts. At the same time, in our survey for the last few quarters, almost 2 years, AI has been right at the top of investors' sort of most preferred segment to play in or look at opportunities in. On that basis, how are you guys dealing with more competitive rounds, the risk of getting into sort of the bubble territory and overpaying for opportunities? How are you assessing how much you're willing to pay to get into a hot AI company on the basis that maybe the business fundamentals of the AI company versus the non-AI company actually look very similar at the time of investment? How do you sort of avoid getting into the trap that some of us fell into in 2021, where valuations got a little bit ahead of themselves?
Well, first thing I would do is I wouldn't think about them as AI companies. They're a company operating in some sort of industry vertical or multiple industry verticals, and you've got to assess it on that basis. They're just they are supplemented by AI or made more efficient by AI or made more, viral by AI or something like that. And so they do have the capacity to grow a lot quicker. So that would potentially justify a higher valuation and therefore, the better return for us. So we have to assess it case by case, really, from my point of view. And it's what the industry can sustain and the growth that they can execute on.
I agree with Quinton, absolutely. These AI companies are definitely able to hit milestones and kind of demonstrate some of those crucial elements of product market fit much earlier. I think we have a little bit of flexibility on valuation because, a key part of valuation for investors is making sure we have the ownership levels that we need on entry to have a great outcome for founders and investors alike on the exit. So two parts kind of go into that. One, it's not only us paying higher prices for AI startups in the US. AI seed companies achieve a 40% higher valuation than they do non-AI seed companies. So that means that, if we pay a bit more on our pre-seed, hopefully there's still that kind of bump up to that US seed. I think our view is the market size also for these businesses is astronomical. And therefore, maybe a smaller ownership when we enter doesn't matter if we're not expecting a unicorn type outcome, but like a multi-billion-dollar outcome. A slightly smaller, I'm going with slightly smaller ownership entry at entry won't impact our ability to have great exit outcomes if these businesses end up achieving kind of multiples of the outcome levels that we're talking about today.
Yeah, makes sense. So pivoting away from AI, I think my sense is that the vibe of the market is a lot better than where we were, certainly in 23, and I would say even better than 24. But the data in terms of number of deals getting announced, the quantum of capital getting put to work is not really keeping pace with my very technical vibe. What are you seeing in the market in terms of the number of opportunities that you're seeing, the number of deals that are getting done either by yourselves or by other investors? And why do you think we're not seeing like a real uptick in the quantum of deals and the quantum of capital being deployed? Is it a supply issue in that there's just not as many companies coming to market, or is it, is that a demand issue? Or is it on the other side that there's not as many investors that have a lot of capital to deploy or that they're holding back investing on the basis that they're sort of the two factors that feed into deals getting done? What are you seeing on the ground?
There was deals that got done in 21 that should never have got done. Like that's the reality. And one of the factors from that is the exit of family offices and high net worth trying to do venture capital deals, at least on their own. And so that's probably taken some capital out of the market and reduced the number of deals. But in terms of quality, I actually think it's gone up, to be honest. And I think in terms of at the fund level, and Taryn I'll let you speak in a second, is we've actually seen an uptick this year in the quality and also the volume of deals. And so I think your vibe is closer to what we're seeing on the ground. Now, obviously, we don't have that 30,000-foot view, but I think maybe it's just investors are a little bit more cautious this time around, having been burnt only, 2 years ago, sort of thing, 2-3 years ago.
Yeah, I absolutely agree with that. I'm definitely agree with the vibe feeling, Chris. We're seeing as many deals as we've ever seen. Agree, Quinton, the quality is really high. I think there's a third component there in terms of just deals being announced. If we think about why would a startup announce a deal, sometimes it's to hire team. We're seeing some of these AI startups not needing to hire such a big team. The second reason can be to acquire customers, but particularly AI businesses, a lot of them are just naturally less defensible. So perhaps they're kind of trading off the acquisition of new customers to stay in stealth just a little bit longer, build a bit more of a moat up, and being a bit quiet. And then, we always use announcements quite strategically. So it's kind of actually don't announce the pre-seed, but when you're about to go out and raise the seed round or the Series A, kind of make a big show and dance of it and get the kind of attention you want then, and really maximize that next round of capital. So potentially that's another dynamic that's playing into it. Who really knows? But yeah, 100% agree that it really does feel like there's a lot of exciting, high quality deals out there at the moment. And so we're keen to just see more of them.
That's a really
I
interesting.
agree. Sorry, go for it, Quinton.
You know, that's an interesting point that Taryn raises, and I've actually seen it just recently in terms of we have a portfolio company that's done a portfolio between Rampersand and Archangel that's done 2 rounds of funding and hasn't even announced one of those rounds yet. So that is an element that could be playing into as well.
Yeah, and that's a needle that we try and thread a cut through. There's a number of deals in our database that we're not releasing, in that we found out about them in sort of private ways and consult with the companies to say, hey, we understand that you don't necessarily want to, or you want to use your language, Taryn, to be strategic in terms of an announcement. And so we hold back some of that deal announcement of those deal announcements, so that we don't sort of rustle the feathers just for the sake of including a few extra deals, but we're comfortable that there's the bulk of the deals so that we're sort of telling an accurate story at a macro level. Quinton, you touched on different investors sort of exiting the market. You touched on high net worths and family offices maybe not acting as independent investors, maybe coming in through funds or syndicates. Are there any other investor groups that you've seen more or less active over the last, say, 6 months? For instance, international investors or angel groups or anyone else?
Yeah, particularly international investors. We've seen quite a bit of inbounding. Obviously, the Singaporean funds have been, Southeast Asian, but particularly Singaporean funds have been very interested in Australian B2B SaaS companies, having not really been that segment not really being successful in Asia. And also some of the US funds have come back to, with some interest that they sort of shrank away previously and sort of retreated to the homeland. Yeah.
Chris, you might have the best perspective, but I'm seeing more angels kind of around and kind of angel syndicates pulling together bigger rounds again than they kind of did maybe at 2024. I don't know if you kind of get that sense as well.
Yeah, I think that there are maybe less angel syndicates, but the ones that still exist are bigger. So I think platforms like GXE and Aussie Angels have made it very easy to spin up a syndicate. And I think that there was a flood of new entrants, people that wanted to do it side of desk and thought that they'd be able to run a syndicate successfully because they were getting access to decent deal flow. It's a lot of work to do that. And I think also that there was a bit of a diffusion of, with so many options with the syndicates that, you're sort of spreading the same pool of angels across them. And so I think some of the stronger ones have survived, thrived, and are growing bigger and are cutting larger checks as syndicates. But I think that there are probably less. We're speaking to Cheryl next, and she will have a perspective on that. But I think that there's definitely some that have really grown to sort of be able to write $500,000, $1 million checks, whilst in 2024 there were a lot of angel syndicates out there that were writing some much smaller checks. So it's definitely a change in dynamic, but I think a positive one in that, if you're an angel syndicate that's writing very, very, very small checks, yes, it's helpful and can be useful to a company, but at the end of the day, you want you need more people that are willing to invest earlier with larger checks. So we see it as a positive.
Chris, are you seeing the thematic ones staying or the thematics dropping off?
That's a good question. So I think certain sectors, the thematics seem to be working really well. Climate is probably the best example of that, where you can rally together, and medtech and health tech, you can rally together a group of pretty easily defined passionate angels that want to back a certain sector. So I think definitely those syndicates that are more concentrated on a specific space, A, it's easier for customer acquisition of angels because you know who you're looking for, and B, I think particularly in medtech and biotech, your angel group is actually of high income earning potential angels in doctors or medical professionals is quite high as well. I think some of the other sectors, so our syndicate that we run through Cut Through is a very small syndicate, a lot of people, but we do 4 or 5 deals a year. That is a generalist fund. So we'll do anything in software. We do find that the flexibility that gives us is that we can sort of try and structure a diversified set of deals over the course of the year that will maybe not have a lot of repeat angels from within the syndicate participate in all of them, but because we do have a big base, we're able to sort of fill the rounds with different cohorts. But I think there's definite advantage to specialization in a syndicate, just like there is in a fund. Final question, guys, and I think like getting right into the nitty gritty detail of what you're seeing as deals go on. So how competitive are the deals? How quickly are they getting done? How much competitive tension is there within deals? Obviously in 2021, our surveys and sort of feedback from the market was things were happening so quick that no one really knew what was going on. Term sheets were getting signed or submitted without really a full data room being opened. And as a result, diligence processes really shortened and pricing as a result, and deal terms probably got a little sloppy as well. What are you seeing at the moment in terms of the deals that are getting done and the processes that you're participating in or choosing not to participate in?
I'll go.
Quentin?
So we're super early, so so that sort of dissipated. I think now it's hit a natural equilibrium in terms of the ability for rounds to get done in a relatively not useful, but reasonable time period in terms of the due diligence, the documentation, all this sort of stuff. There is some competition, but it's not overly competitive. I'm sure every now and again there's a company, a set of founders that have come out of maybe a unicorn or something like that, and there's a few term sheets flying around for that particular company. But overall, we've seen it's been pretty collaborative in our ecosystem in terms of who wants to do deals, how much they can take up, and working with the founders to really understand their business and why this is a great opportunity. So, you know, it's probably in a pretty good space if I'm honest.
I 100% agree with that, Quentin. I think the only other thing to add is I think like the legal document process is getting better. Like I do feel like our ecosystem is maturing. The angels, the investors, the founders all kind of have that market standard. No one's trying to push too far in either direction. And so that just means that process is getting done a lot faster, which means no one's wasting time and everyone's just getting on with things, which is awesome.
So awesome. If you choose the right lawyer, Karen.
Absolutely.
We're bring the lawyer fees down. How do we bring the lawyer fees down? If the process is getting quicker, then the lawyer fees should go lower.
Exactly. They need to be using some AI technology in there.
Yeah, rumours are they are. Guys, thank you so much for joining. Next up, we've got Cheryl and Ian joining us for a bit of a broader view on the market. But thank you guys so much for joining, and I'll see you soon.
Thanks, Chris. Thanks, Quentin.
All right, before we welcome our final guest for today, let me tell you again about Vanta. Automate compliance, manage risk, improve trust continuously. Vanta's trust management platform takes the manual work out of security compliance processes and replaces it with continuous automation. Whether you're pursuing your first framework or managing a complex program, Vanta is a great option for your business. Thank you again, Vanta, for your support and helping us bring this together. And with that, let's welcome to the stage our final callers, Cheryl Mack from Aussie Angels and Ian Gardner from GLX Ventures and Innovation Bay. Welcome, Cheryl and Ian. It'd be great to start with some intros. Cheryl, why don't you kick off?
Yeah, absolutely. Thanks so much for having me. Excited to do this. My name is Cheryl Mack. I am the founder and CEO of Aussie Angels, which is the platform that supports investors to run their own small funds and syndicates. We have been around for about 3 years and deployed about 50 million in capital. I'm also an angel investor. I've invested in about 32 companies directly. I'm a venture partner at Black Nova and just all around startup champion.
Awesome. And Ian?
Yeah, thanks, Chris. I am Ian Gardner. I guess I wear two hats. So one is with Innovation Base, which is a community group for startup founders, startups, and investors. Amazingly, we've been going since 2002 when I moved to Australia, and it's just an amazing community. We're mission driven about building a better ecosystem. We're just trying to create as many $100 million revenue startup companies as possible. But I'm also an investor with Gelix Ventures, and that is our $30 million venture fund, pretty much fully deployed. And in amongst all of that startup passion, we've done a lot of angel investing and fund investing through both Innovation Bay and Gelix. So yeah, definitely core part of this ecosystem.
Awesome. Well, thank you both for joining. And as you both sort of highlighted in your introductions, you're both super connected across all parts of the ecosystem. So to start off, I'd love to get really a vibe check. So you work with angels, investors, operators, founders. In our last report that came out last week, the vibe amongst professional investors seemed very positive, albeit deals and deal volume is quite slow. So Cheryl, I'd love to kick off with you. Just what's the mood amongst all of the, I guess, stakeholders in the ecosystem from your perspective?
Sure. There are a lot of stakeholders in this ecosystem. I'll start with founders. Generally, the mood that I'm seeing is founders that are meeting a certain bar of traction are feeling really good. And that's evidenced by the fact that they're not struggling too much to raise money. Founders that aren't, and that bar has shifted, I think we can acknowledge that, but founders that aren't seeing the level of traction that they had hoped for or that they had forecasted for are definitely struggling. Without free money, it is a lot tougher for those companies to raise, and we are seeing companies run out of money and the negativities that are associated with that. On the investor side, absolutely positive. The number of angels that are coming into our ecosystem, it just is skyrocketing. And I think on the professional investor side, so the fund managers and syndicate leads on our platform are also feeling really excited about the quality of companies, but also the opportunities. Like I said, when there isn't free money, it means that investors get a better deal.
Ian?
Yeah, I'd maybe be a little more, I'm still optimistic. It's definitely improved. And I guess that's the phrase I'd put on it, it's improved. We're all coming out the, 21, 22, almost crazy time where, it was boom time back then. We are not in that situation now. 22, 23, a lot of 24 was a challenging time for a lot of startups and investors. Venture is not an asset class that works well with high interest rates, and that's been hard. And interest rates are still relatively high. So, just give me a sec. Sorry. So when interest rates are high, yeah, I don't know how much this has been recorded, but my bicycle's in here and I'm getting in trouble for not moving it. So anyway, it is improving is the punchline. So what we're seeing with angel investors is more activity than we'd seen in quite a long time. So we'd seen deals getting done that I didn't think would get done. And we're seeing an improvement in the LP sentiment within VC funds. And that's been really tough. And it's still tough out there. You're seeing very few, second-time funds are struggling to raise. First-time funds are struggling to get it off the ground. So it is definitely difficult for the LPs out there or the VCs out there to raise and get them off the ground.
And do you think on that basis, so there are probably fewer Australian funds out there hunting around for deals, and could that be part of the reason why it has been a little slower start to the year than what we maybe thought?
Depends what time frame are we saying here? Fewer Australian funds hunting around for deals than 12 months ago, 24 months ago, or 5 years ago?
That is a fair question. More responding directly to Ian's comment around funds struggling to raise follow-on funds. If there aren't as many funds that maybe were active that raised a fund in 2021 but have not raised a subsequent fund, I guess, like, on the balance, do you think that is potentially cutting back the supply of capital that is chasing after local deals?
Yeah, I mean, I guess there's a number of funds I can name that were deploying 12 to 24 months ago that are no longer deploying. And so if you follow that thread through and think about the number of investors that are openly writing new checks, especially at the early stages, I think it has reduced. We see that a little bit in the data across the platform on Aussie Angels, where the number of co-investors, like, we've probably co-invested with every VC in the country at this point. But I would say that maybe in the last 6 to 12 months, that number in terms of variety has shrunk, and we're seeing the same repeat players that are the ones that are still deploying checks.
Yeah.
Ian?
I mean, I'd say there's a sort of macro theme going on here. So the big funds like, Blackbird and Airtree, I think Airtree just closed a pretty large
they never run out of money.
Fifth or sixth fund, but most of that money is institutional, so they're getting super money and overseas pension funds and whatnot coming into the market. So the big funds are doing pretty well because they can go out and raise their follow-on capital. The smaller funds, who are raising from mostly individuals rather than institutional money, they're the ones that are struggling. And so there's a concern that I've got, which is that the big guys are going to get bigger and the small guys are not going to be able to thrive in the way that they were. Now, I can't predict the future, and I don't know where that ends up, but there is a world where it would be good to see some way of unlocking some of that Aussie super money that could cascade down to the earlier stage managers rather than just the big end of town.
Yeah, for sure.
Yeah, because I think someone said, and I think this is accurate, that no super fund has deployed to a new fund manager in the last 3 years, which, like, that's concerning, right? It's supporting the fact that the big ones are likely to get bigger, and emerging fund managers are likely to struggle if we're not seeing any new super funds deploying.
It's a structural problem. I mean, like Host Plus, now it's merged with a few other, like Aware Super and a few others. I mean, they're over $100 billion, and there's, I think, $8 or $9 billion of new cash coming into that fund every year. How can they deploy that?
But they haven't chosen a new fund manager yet in the last 3 years.
But I just don't think they can, unless the check size is 100 million plus. Then it's just not really worth their while touching it. So that's a problem.
We need more fund of funds.
The super funds on the webinar, you've heard it. Plenty of opportunities for some of the other funds outside of the big guys. You touched on interest rates being a drag on deployment and just generally the industry. Another factor that has really, I think, impacted confidence to deploy and willingness as an LP to deploy has been some of the regulatory factors. Obviously, last year, Cheryl, you were very involved with working against the proposed changes around sophisticated investor test. Obviously, more recently, there is discussions around changing superannuation taxing of unrealized capital gains. None of these things are necessarily great for potential angels or individuals that want to invest in funds. Is that something, are those thematics things that you're coming up against within your different communities?
For me, honestly, like, that was a point in time last year that there was concern so there's two there that you mentioned, right? Let's just tackle the first one, which was the potential wholesale investor changes. So that came to light early last year in 2024 and was successfully squashed by a number of us in the ecosystem by the end of the year. There did create a certain amount of uncertainty, which is never good for any investment ecosystem. However, it actually, on an angel investor perspective, it actually created the opposite, where we saw more investors wanting to write their first checks to get in and get the experience that would allow them to hold on to that after if they were going to be potentially changed. So it actually almost had the opposite effect. like on an individual level, but on a whole, like overall, uncertainty is never good. And so I do think that there was a decent amount of negative effect. On this current one, I think the dynamics of this proposed change are very different. Where in the first instance, we had the opportunity to fight and were successful. In this instance, it's much less likely. On the first one, it was very much a like, don't hurt the little guy. This is about inclusivity. Versus this time around, this super tax is seen more as like a, why are you fighting for the rich guy kind of thing. But I would say that the uncertainty this is causing is not good. I don't think on an actual deployment level, like no angel that I've talked to has said, I'm not going to invest because I'm going to stop angel investing because my taxes, my super might at some point in the future be over 3 million and I'll get taxed on that. So I don't think it's actually having a specific negative impact on angel investors. But again, anything that creates uncertainty in the ecosystem is not good and does have an overall general negative effect. What do you think, Ian?
Yeah, no, I definitely agree with that. I'm not seeing the effect of this super tax specifically in individual investors. I think it's more the effect it has on the ecosystem. Just it's a negative. I mean, like, why should you tax unrealized gains? I mean, it's a crazy policy. If you haven't got liquidity, I mean, this whole asset class has a lack of liquidity often within it, and so getting taxed on that just makes no sense, and that uncertainty doesn't lead to good outcomes.
Yeah, well, given we started off on a bit of a negative note, some positive stuff now. You guys have been around in the ecosystem for a while. Would love to get your perspective on, if you park the market activity to the side, what are some of the bigger changes that you've seen in the last few years in terms of the broader startup ecosystem? Why don't I kick off with you, Ian?
I mean, in some ways it's a tech change. I mean, I was involved, I ran the AWS startup team for a few years just at the dawn of cloud. And that was probably the number one change that we've seen. And it's not just AWS. I mean, you've got Google, you've got Azure. I mean, there's players in the space. And that was a major step change for startups. I mean, suddenly you had infinite computing power at your fingertips that you only paid for when you used it. It was a complete game changer in terms of how companies scale. And then the latest one, I mean, just about every VC and investor conversation I have, or certainly when you bring them together in groups, as we do with Innovation Bay, the number one topic's AI. That's all they seem to talk about. So it's a genuine macro trend. It's going to be incredibly impactful. I think we're still at the early stages of what that is actually going to mean. But tech trends would be one of the main things. I'd probably also add into that talent. I mean, you've got some of the big guys like Canva and Atlassian and Afterpay. I mean, they've done really well, and they've spun out, wealthy staff members who've gone on to create their own startups. And you've just got this talent and money coming into the ecosystem in a way that you never had. So better, more sophisticated founders with better tech, and overall, I mean, what we're doing here, even you, Chris, I mean, you came in from the US and you started Cut Through, and you are a core part of this ecosystem, and like you weren't around a while ago. Cheryl's fairly new as well, not relatively new, but you're much younger than me. I mean, I've been around forever. But that time ago there was really nothing, and now there's something. So it's a very, very positive time.
Awesome. Cheryl?
Yeah, so there's a few things that I've noticed. I'll start with one that's kind of building on what Ian said. One of the things that had a profound impact actually in Australia was the COVID era, because it brought a lot of really strong talent home to Australia. And that birthed a lot of new companies being founded here, investor money coming in the door for early stage businesses, and talent for those companies, and sophistication as well. You came back from New York, right? If I'm not mistaken.
Yeah.
Yeah, you came back from New York, and you brought some of your New York, acumen and experience and skills, and dropped it into our ecosystem. And you're just one example. I know hundreds of them. And so that actually created a fairly significant change that maybe was hard to track, But absolutely, I saw, having been here for 11 years now, and that period happened about 4 or 5 years ago now, right? So that was about halfway through when I've been here. The second piece that I've seen greatly change in the last, again, I've been here 11 years, and about the 11 years that I've been here is just the explosion in investment. When I first landed here, it was basically, Blackbird, Airtree, Rampersand, EVP, and like I don't even think OIF was around actually. What's the other one? SquarePeg.
Yeah, you missed SquarePeg. Yeah.
Yeah, SquarePeg. I was like, I know there's the top 3 there. And that was it, right? And I was really hard pressed to find a solid group of angel investors, even when I started angel investing 5-6 years ago. So that explosion having gone from maybe 3 to 5 funds to how many are part of our Aurora group, like 130.
100.
Yeah, right. Like that's crazy. And that's a very short period of time. So speed is another thing that I have seen the ecosystem just accelerate in the time that I've been here. And that acceleration, I think, one, is not stopping, but two, is the pace that I've seen, I think, is a huge change. And then lastly, I think a really exciting one that I noted down is that when I first started getting involved, when I landed here, it was all Sydney, Melbourne, Brisbane, Sydney, Melbourne, a little bit of Brisbane. Now, we've seen great companies come out of Adelaide. There's so much more activity in Perth and a lot more in Brisbane, even Gold Coast and far north Queensland up in Cairns. So I think the ecosystem has both expanded and become more inclusive. We did our venture down under up in Darwin even last year, and just to include that space, to talk to some of the investors there, to realize that, hey, we're actually, one, generating innovation everywhere, and two, that capital is being deployed everywhere. So I think that's a pretty big change that I've seen.
Yeah.
Awesome. I love the optimism. So Ian, I'd love to ask you a question. What does give you optimism about the ecosystem, where we are today, what we can be? What are some of the signals that you're seeing that should give us all reason to be optimistic about the future?
Yeah, well, I mean, Cheryl alluded to it, that boomerang of existing talent coming back. So people like you, and you're definitely seeing Aussies, specifically in America, are coming back. I mean, you don't want to point fingers too much, but the current White House administration is not necessarily favorable to people who aren't, that core American, whatever that is. But that's even scaring off some of the Americans. So you're even seeing, I've heard stories of talent that you wouldn't otherwise have expected to want to come and live and work in Australia from America, coming and wanting to work here. So when you've got that, we are an immigrant nation, and when you've got that immigrant talent coming in a way that it hasn't in the past, that's incredibly exciting, and that's something that we really should be celebrating and looking forward to. I think also the pipeline of startup successes. I mean, we've you can rattle off the big ones that I did. So Canva, Atlassian, Afterpay, WiseTech. Some amazing companies, but there's a whole generation coming through. I mean, there's hundreds of $100 million startups being created in the last few years, and there's more coming. So just
unicorns.
The talent pipeline is incredibly positive. And Australia, I think, has a global reputation that's growing around tech that was not there before, and I think that's there's a lot to be really excited about.
Anything to add there, Cheryl?
Yeah, so there is a report that recently came out which confirms something that is something that I have anecdotally said on multiple occasions, and that is, we've often, I think, as investors ourselves, we've often pointed out that Australia is very capital efficient, and it is a fantastic place to hire great talent, and that we have more unicorns per capita invested or per dollar invested than any other country. Now, that's something that I've only alluded to previously. I've said things like, we've got 2 companies valued at over $20 billion, whereas the UK, a much bigger ecosystem in terms of VC dollars invested, has 0. So we're punching above our weight. But a report just came out that actually did the research on this and showed that Australia is actually #1 ranked in terms of unicorns created per venture dollar invested. So if you are an investor and you are looking to invest in unicorns, then your dollar goes further in this country. And I think that is a very exciting thing to get excited about.
Agreed, and well done to Ben on that report. I know what it's like to make reports, and so I sent him a text.
No, you wouldn't know anything.
I sent him a text to see if he was in a cycle or not after doing all that work, but no, it was a very good report. Look, guys, I think it's a perfect note to end. Really appreciate you joining today. And thank you to Taryn, Quinton, James, Jackie, and of course our sponsors for today, Vanta. Really appreciate the support. Thank you to everyone that joined, and we look forward to seeing you soon. See you later.